If you're interested in joining an investment bank, you got to know some things about how markets operate. Hello, everybody, and welcome to this video on investment banking operations, where these are the top 10 potential interview questions that would come in an IB Ops interview. Do you know market technicalities? I am your learning partner, Sushila Hariharan, and I teach on fund accounting, corporate actions, trade life cycle, and OTC derivatives for some of the largest investment banks in the world at multiple locations. If you have a query and you want to know more, please send in an email to globalmarketsacademy@gmail.com. Let's take a look at this. The structure of this interview series is different from the videos that I've uploaded to now. Let's find out what are the little changes that I've made on this. First of all, this specific video is very useful for people who are appearing for stock exchange broker examinations, distributor examinations, etc. Okay, so those of us who are applying and are planning to write these exams and get the certifications from the regulator and from the stock exchange, I urge you to go through this video slowly and understand the mechanics. It's a learning resource for chartered accountants, CMAs, CFAs, FRMs, etc., who are keen to join investment banking in compliance and regulations, because some of the questions over here are dealing with compliance issues, regulatory issues, etc., are dealing with compliance issues, regulation, and so on. It's a knowledge video for investment professionals who are eager to join global investment banks and they want to brush up their knowledge on these topics. So here are 10 potential questions. After every question is asked, I'm giving you 4 options. I'm giving you 10 seconds to test your own knowledge. So please bring a pen and a paper with you before you start this interview series. It's almost like a mock exam. Okay? And there is detailed explanation provided at the end of every question as to why that answer was selected. So don't just skim through the slides, don't just fast forward the videos, pause it in, absorb the information, absorb the knowledge. Do so at your own sweet time, but definitely do that, because then if you're asked these questions at the next stage of the interview, right? These are questions that can come up in the written test. But if you're asked these questions at the interview stage, then you should have that knowledge as to why you had selected this as the answer. Okay, you can't just go and say, hey, I guessed the answer, or I was doing ini mini mana mo, etc., because those are not actually valid answers for your explanations. All right, so are you ready? Are you ready with your pen and paper, etc., taking a go at this? Let's start with the first question. Okay, what is a market order? As you know, stock exchanges require you to define your order as either a market order or a price order. So in a market order, which of these following elements will be present or will not be present? The first one, the market order must mention the quantity or volume of the order and the trigger price. Okay? Is it B? It mentions only the trigger price. Is it C? It mentions only the quantity and the volume of the order, implying that when you're feeding in a market order, you click on that market order and then you put in market and price, the market price or the trigger price or both, and the volume, etc. Or is it D? It mentions the stock market on which it is to be executed. I mean, it's a market order, right? Your 10 seconds starts now. 8. If you've got the right answer, then you would have highlighted it mentions only the quantity or the volume of the order. Why is this the case? This is because a market order, it implies that you are keen to execute the order. So therefore, the order gets triggered at the last traded price. So you are price agnostic, and therefore, whatever is the quantity that you desire to buy in the portfolio for the fund will get executed. All right. So that's the explanation as to why we chose option C, which is mentions only quantity and volume of the order. Let's take a look at the second question. What is upper circuit for a specific stock? Okay, the stock exchange is a regulatory organization as well. So prices are regulated, but they're not controlled. Okay, big difference. So therefore, prices cannot run away either in the upward direction, nor can they collapse in the downward direction. And hence, stock exchanges put in place circuits. So, an upper circuit indicates that the price has reached dizzying heights in one specific day. What happens then? How does that get automated? A. Only buy orders will be accepted by the stock exchange system. Is it B? Only sell orders will get accepted by the stock exchange system. Is it C? The stock is repriced to zero. Or is it D? Both buy and sell orders are accepted. Let's understand this. The four options given to you about upper circuit. Upper circuit means the price has hit the highest possible level for that particular day. Only buy orders are accepted, only sell orders are accepted, the stock is repriced to zero, or is it both buy and sell orders are accepted? Your 10 seconds starts now. And your time is up. If you have selected only sell orders are accepted, then you're right, my friends, because the price is frozen at the upper circuit. When the price is frozen at the upper circuit, it means the price cannot go any higher. And if the price cannot go any higher, buy orders cannot be executed. So the reverse is also true. If there's a lower circuit, it means only buy orders can be accepted, right? So trigger prices, circuit prices are very critical in controlling and regulating the movement of prices on the stock exchange so that the stock prices do not have a runaway into a very dramatically bullish phase or a dramatically bearish phase. In India, we call these as surveillance measures. This is ASM and GSM. Okay? I mean, GSM first and then ASM. Third question, a proprietary trade means investment bank is trading for client account. Okay, there are multiple trades that investment banks do. So therefore, what is a proprietary trade? Also shortened to call as a prop trade. A prop trade means an investment bank is trading for the client account. Is it that an investment bank is squaring off the position? Is it the investment bank is trading for employee accounts? All of them are done by the investment bank. Or is it investment bank is trading on its own account? Your 10 seconds starts now. We are halfway down now. And now we're counting down to the lasts. And your time's up. If you thought the answer is investment bank is trading for the client account, you're completely wrong. Okay? Proprietary, what is the meaning of proprietary in English? Your own. Okay? This is proprietary patent. This is proprietary design. This is a proprietary shop. It means your own. Okay? The English meaning, the accounting meaning is that proprietary is your own, and therefore the right answer is indeed investment bank is trading on its own account. Question number 4. Market capitalization. This is a ratio that is asked in almost all interviews that I have seen till now, okay? Because every time I see this question being asked, I find that more than 70% of the people get the answer wrong. And I never tire of asking this question as what is the formula for market capitalization? Because in the stock exchange, you're dealing with large cap stocks, mid cap stocks, small cap stocks. So then you got to know, what do I mean by that, right? What do I mean by small cap, mid cap, large cap, etc.? But if you want to understand what is the meaning of that, you got to be able to know what it actually implies. So let's try and understand that. The four options given to you are, first one, the number of shares issued multiplied by the traded price. The asterisk actually means multiplication. Is it number of shares traded multiplied by the IPO price? Okay, it gets more and more bizarre. Is it number of shares traded multiplied by the traded price? Or is it number of shares issued multiplied by the IPO price? Okay, that could mean anything. So your 10 seconds starts now. Counting down to the last 5 seconds. And your time's up. Most people would select number of shares traded multiplied by the traded price, which is not the right answer. The right answer is indeed number of shares issued. Okay, outstanding, issued, and paid up multiplied by the traded price. That is market capitalization. The market volume is number of shares traded multiplied by the traded price. All right, and that could result into short positions, long positions, positions not yet squared off, and so on and so forth. That's in another interview series, but these are the basic concepts of understanding why we have market capitalization. All right, so the right answer indeed is number of shares issued multiplied by the last traded price or the current market price. Okay, the fifth question here in this series is a stop loss limit price for a sell order gets triggered. So initially the trader has inputted a sell order. He's a bearish trader. He has inputted a sell order. He has short sold the stock. And then he has also placed an order to stop loss the price, the stop loss the loss. Okay, so the stop loss limit price. So when he places the stop loss order, he was also mentioned the price at which the stop loss is going to get triggered. Is it the stop loss price is greater than the contracted price, implying that contracted price is when they sold at, let's say, $100, the stop loss price is $110. Okay, is that the first choice? Stop loss price is less than the contracted price. The bank balance is insufficient. The investor does not own the shares at all. So therefore, it automatically the stop loss limit gets triggered. All right. The time starts now. You're counting down to the last 5 seconds, and here is your answer. There is perfectly every reason for the order to get triggered, the squaring of order to get triggered if the investor does not own the shares. Okay, they have to square up by the end of the day or within the settlement cycle. But the question is, what does the stop loss limit price mean? And therefore, the right answer is the stop loss price is greater than the contracted price. So, if I've contracted to sell at $100 and the decision of the trader was wrong, the prices in fact did exactly the opposite, which happens most often in our own portfolio. We sell or we buy at price, and the prices don't move in the expected favor or in the expectation that we thought it would go in. So let's say the contracted price is $100 and the stop loss price is $110. It means you've incurred a loss of about $10 per share, and therefore you want to stop the loss. Okay, you want to stop the loss. The sixth question, the mark to market of outstanding positions. Now, mark to market is a topic that's discussed ad nauseum across various forums because it helps investment banks keep a tight control over the positions, over the securities, over the assets, and so on. So the mark to market of outstanding positions must take place at one specific price at the end of the day. This price is defined by whom? Let's see. Is it valued at the last traded price? Is valued at the daily closing price, DCP? Is it valued at the highest price of the day? Or is it valued at the opening price? So you've bought during the day. At the end of the day, you have to mark to market. So what is the price at which you should mark to market the outstanding position on every single day? Your 10 seconds starts now. And as we are counting down to the last 5 seconds, use your answers to know that the right answer is valued at daily closing price, which is announced by the stock exchange every day. Many people get confused between the first point, that is it valued at the last traded price or is it valued at the daily closing price. The point is it cannot be valued at the last traded price because the last traded price is a single price, whereas the daily closing price is the average prices of all the trades done on that particular stock in the last half an hour of trade. These are all systems and processes put in place by stock exchanges, so there is uniformity and standardization of mark to market. Moving on to the eighth question, The NIFTY 50 index, which is the index of the National Stock Exchange. Now this gets interesting for people who are going to apply for their NISM exams. How is it calculated? Is it the weighted average index of the top 50 revenue companies? Is it the index of the top 50 companies according to price earnings multiple? Is it the index of the top 50 profitable companies only of the IT sector? Or is it a weighted market capitalization index of the top 50 companies? The question, read it very carefully. They're asking you how the Nifty 50 is constructed. Okay. Is it just a weighted average index of the top 50 companies? Is it an index of the top 50 companies? Is it an index of the top 50 profit making companies? Is it a weighted market capitalization index of the top 50 companies? Your 10 seconds starts now. Okay, if you're ready with the timer and you selected the right answer as we count down to the last 3, 2, 1, the right answer is indeed is a weighted market capitalization index of top 50 companies on the Nifty. Okay, so you take top 50 companies, the Standard and Poor organization is managing the index construction. They decide the top 50 companies across various sectors so that it's diversified and it does not represent only one particular industry. It's therefore a weighted market capitalization. Now you understand why I was so keen that you should understand the term market capitalization. The question which was asked just a couple of slides before, right? So you have to know these because all these flow in the same in the same direction, in the same realm of things, because that's how the Nifty operates. Okay. Coming to the second last question, in the last few months, last few years actually, a lot of bankers across international markets of Europe and Northern America have asked this question: what is dark pool trading? Dark pool trading, is it OTC trades? I mean, are they only over the counter trades? Is it the part order is displayed on the terminal? Are these illegal and unauthorized trades? And is it D, the order is placed after market timings? Dark pool trades are available for institutional investors who place in orders running into millions of dollars. In fact, if you look at transactions which are in specific stocks by hedge funds or mutual funds, they could be buying upwards of 100,000 shares of even Google or Facebook. And therefore, the volume of the order is very large. Okay, your 10 seconds starts now. And as we count down to the last 5, 2, 1, 0, your time's up. The part order is displayed on the terminal. The rest of the participants in the stock market don't know the full order size. They only know the part order. Dark pool trading is not OTC, it is an exchange traded contract. It is not illegal. It is not placed after market timings. Only a part order is displayed so as to not disrupt the market from the various prices. Moving on to the last question, T+1 rolling settlement this year 2023. Stock exchanges in India move towards T+1 rolling settlement market. That means every day is a settlement for the previous trading day. So my question to you all is the record date for such a market the last working day of the month? Is it the same as the X date? Is the record date after the X date? Or is it in a T+1 market, the record date is before the X date? All right. Your 10 seconds starts now. If you're ready, the timings. Last 2, 1. And what is your answer? If you have selected the fourth option, then you are wrong, because in a T+2 market that would have been correct, like the New York Stock Exchange or the Tokyo Stock Exchange. But in a T+1 market like NSE BSE, the record date is the same as the X date since 2023. Okay. Thank you so much for listening into this video, for watching the contents. If you like the content, please hit the like button, subscribe to my YouTube channel, and share the content with your friends so that they also can get a chance to test their knowledge on investment banking operations. Thank you so much from